Hi, this is Chiro. In this video, I'm going to go over how to invest. If you're already familiar with investing and options, check out the playlist in the top right corner to see how I've applied these strategies to various companies. As a disclaimer, I'm not a qualified investment advisor, and nothing in this video should be taken as investment advice. My intent with this video is for a total beginner to investing to understand what investing is and why they should consider investing. The video will then cover the different ways you can invest, such as bonds, stocks, mutual funds, and ETFs, and the advantages and disadvantages of each method. Lastly, there will be an introduction into options, how they work, and when you might consider using them. If there are specific topics you're interested in, feel free to skip ahead. I've left timestamps in the description. So first off, what is investing? The simplest way I can describe it is putting money somewhere with the expectation that the money will grow or otherwise be worth more in the future. Some examples of this might be buying something with the intent to sell them for more in the future, such as gold, Bitcoin, stocks, or rare Pokemon cards. Next, we'll move into why you should invest, and secondarily, how investing is different than gambling. Why you should invest is fairly simple. You expect the thing you're investing in to be worth more in the future. Now, the reason you expect this to happen is more than just blind faith. It's pretty blind but not quite legally blind faith. Taking a coin flip as an example, a fair bet might be for me to give you $1 if it's heads and for you to pay me $1 if it's tails. After 1,000 flips, no one is expected to come out ahead, and it was probably just a huge waste of time. In a casino, the payout would be more like me paying you 90 cents if it's heads and you paying me $1 if it's tails. You might still win sometimes, but after 1,000 flips I'll probably be ahead and will still have wasted a lot of time. One lesson you could take away from this is that you should start a casino, but what I'm trying to get at is that the odds with investing are favorable, like if winning the coin flip paid you a little more than the dollar that you stand to lose. As an example of how this works, let's look at a student loan. You might be willing to give a student, say, $10 to go to school, knowing that once they graduate, they'll most likely find a job and earn enough money to pay you back, say, $11. In this example, unless the student dies, the student will probably be able to pay back the $11 and you'll end up with more money than you started with. Hopefully these examples explained why you should consider investing and how investing differs from gambling. Next, we'll discuss what kind of things you can invest in. Some examples of things you can invest in includes bonds, stocks, mutual funds, and ETFs, and we're going to go through some of the advantages and disadvantages of each. At this point, I'm going to re-emphasize this disclaimer and highlight that you should do your own research or talk to an advisor before investing into a particular product. Buying bonds is possibly the most directly comparable to our student loan example. A company that needs to borrow money, for example to construct a factory or buy a holographic Charizard to make money, may issue bonds that you can buy and will commit to paying you a certain amount of interest per year until the bond matures or expires, at which point you get your money back. In our example, you're buying a company bond for $10 in return for $1 per year for 5 years, after which point you get your $10 back as well as some interest. Like with the student loan, the risk here is that in the unlikely situation where the company goes bankrupt, you may not get some interest or your money back. With this in mind, a company that is more likely to go bankrupt will likely also offer a better interest rate to compensate for this risk. Governments can also borrow money in various ways, and you might hear them referred to by a bunch of names, such as bills, notes, or treasuries. In general, bonds are quite low risk, but the return on investment for them is similarly low. Buying stocks or shares of a company entitles you to a fraction of the total value of a company, as well as a share of the profits they earn. If some unfortunate student was treated as a company, you might be able to invest $100,000 into the person in return for 10% of all their future salary. Putting it all on this one student is risky. If they end up finding a great job and striking it rich, you stand to make a lot more than $100,000. But if they spent all of it on holographic Charizards and end up jobless for a long time, you might never make back your money. In short, investing in individual companies can be lucrative but comes with a lot of risk. Having said that, with some research, good choices, and a little luck, you could profit massively. Now on to mutual funds. If you stepped into your bank and said you wanted to start investing, you'll probably be presented with a mutual fund or two. In terms of investing, mutual funds are just a basket or collection of companies, which means that over time you'll see a lot less fluctuation in value. Outstanding results from a single company won't benefit your investments as much, but a few companies failing or going bankrupt also won't crush your portfolio. Mutual funds will generally invest in a variety of bonds and companies in different sectors and possibly countries, and your broker may be able to tailor a set of mutual funds to suit your risk profile and preferences. This is all well and good, but mutual funds are typically run by a management team who researches the companies they hold and may actively buy or sell investments as they see fit. The cost of managing the fund is known as the MER, or Management Expense Ratio, and is on average about 2.5% for mutual funds. For a $100 investment, this would mean that you're paying $250, or about 1% of a holographic Charizard, a year to hold the mutual fund. In general, the fund will earn you more than $250 per year, so you should still be coming out ahead, but bear in mind that this fee can have a significant impact on your returns. Having said that, mutual funds are definitely a simple, almost zero effort way to get into investing with a diverse portfolio. Exchange-traded funds, or ETFs, are the last way to invest that we're going to discuss in this video before moving on to options. Like mutual funds, an ETF is usually made up of individual bonds or companies, which again reduces the risk of losing a disproportionate amount of money due to a small number of poor investments. Unlike mutual funds, however, ETFs are often based on an index, such as the S&P 500, which is essentially a list of the companies in the United States with the largest market cap. As a result, changes in the index can be automated to a higher degree, which leads to lower management expense ratios closer to 0.5%. Picking an ETF or ETFs to invest in will generally be simpler and significantly less risky, although potentially less rewarding, than picking individual stocks. And ETFs will typically perform as well as mutual funds without incurring as high a fee. ETFs probably strike the best balance in terms of needing little to no maintenance without sacrificing diversity. Having covered the main ways you can invest, we'll talk about how you can adjust your strategies and risk profile using options. I don't discuss the Greeks of options trading or how to determine if a particular contract is worthwhile or not in this video. I also want to re-emphasize the disclaimer here one more time, because while options can be a useful tool to manage risk, they can also result in you losing more money than you invested to begin with, something that's difficult to do with normal investments. Lastly, note that while I think it's useful to know what options can do, using options is far from necessary to be a successful investor. Conceptually, it might help to view options as insurance that you can buy or sell. If you bought a share for $10 because you believe the company is going to do well in the future, let's consider 3 scenarios for you selling the shares a year later. First, the shares skyrocket to $20 and you're now $10 richer. Second, the shares remain at $10 and you're no better off than where you started, but you haven't lost anything. Lastly, the shares crash in value and are now only worth $1, and what's worse, you needed the shares to be at least $5 to afford that holographic Charizard you always wanted. If you wanted to avoid this nightmare scenario, you might consider paying someone, say, $1, and say, if the shares are below $5, I'm gonna need you to buy these shares off me. On the other side of this equation, the individual earns $1 no matter what, and might be more than happy to buy a share in the future for $5, or $4 if you consider that they got paid $1 for this. What I just described is buying a put. There are 2 ways to adjust your risk like this: calls and puts. They are typically done in contracts, which represent 100 shares per contract, and might look like this for a call. If I buy a call, I'm willing to pay $1 per share, the premium, for the right to buy 100 shares from you for $5, the strike price, before the end of the year, which is the expiry date. If I sell a call, I'm willing to get paid $1 per share to give you the right to buy 100 shares from me for $5 before the end of the year. This graph shows what the payout would be if you simply bought a share for $5. If the company went bankrupt by the end of the year, you would have lost your $5. If the company were worth $10 at the end of the year, you would have gained $5. If instead I bought a call from you, my payout would instead look like this. Below $5, I wouldn't lose any money even if the shares dropped to $0, because I don't have to buy the shares from you. Above $5, however, I could choose to buy the shares from you for $5. So if the shares were $9 at the end of the year, I still have the right to buy them from you for $5, and if I wanted to, could sell them immediately for $9 to gain $4. On your side as the person I sold the call to, again, nothing happens if the shares drop below $5, as I probably wouldn't choose to pay you $5 for them. However, if the shares rise above $5, I would buy the shares from you for $5, and you would have lost the difference in price. For simplicity, this graph didn't take the premiums into account, but if it did, it would look like this. Note that now we're considering the premium. Even if the shares rose 90 cents, I still end up with less money than I started with. Another thing to note is that selling a call can be very risky. If the shares rocketed to $100 and I didn't already own the shares, or another call as protection, you could exercise your call, and I would need to buy those shares from someone else for $100 and sell them to you for $5. On the upper hand, I suppose the $1 premium softens the blow. You might notice that the lines to the left of the strike price are flat. Puts are kind of the opposite and are flat on the right side of the graph. If I buy a put, I'm willing to pay $1 per share for the right to sell 100 shares to you for $5 before the end of the year. If I sell a put, I'm willing to get paid $1 per share to give you the right to sell 100 shares to me for $5 before the end of the year. The graphs are kind of similar to with calls, but everything happens to the left of the strike price now. If the company goes bankrupt, I could effectively buy shares for $0 and would still have the right to sell you shares for $5. If the shares are at or above $5, I'm probably not going to choose to sell you those shares for $5, so no shares change hands. If I sold the put to you, it's the opposite. I'd be buying shares from you for $5 even if the shares are worth less than $5, but nothing happens otherwise. If I include the premiums, the graphs would look like this. Notice that in this case, the shares would need to drop to $4 for it to have been worth it to buy the put. We've now discussed buying and selling puts and calls, which are the building blocks of pretty much any option strategy to buy or sell shares and ETFs. It might take some practice or experience to remember which is which, but again, it can help to think of options as insurance where you either pay someone to accept a risk or get paid to accept someone else's risk. With this in mind, it follows that the premium that you pay or get paid will depend on a few things. So what determines premium? One factor is the cost of the shares. A higher share price typically demands higher premiums. The second is volatility of the shares. A stock price that moves more or has significant news about to be released will demand a higher premium. The third factor that we'll discuss is the expiry date of the contract, as the longer the contract is, the more it'll cost to protect against share price movement. Lastly, we're going to go over some examples of option strategies. This list isn't exhaustive and I'm not going to go into detail about these strategies, but some common examples of using call options and their associated payoff charts as compared to just buying the shares are as follows, and includes any premiums you may receive. If you buy shares and sell a call, this is typically called a covered call, where you stand to benefit up until the strike price, at which point your upside is limited, but you receive a premium in return. If you buy a call and sell a call at a higher strike price, this is called a bullish or debit call spread. You are effectively paying a bit of money in the hopes that the stock is going to increase over your strike price over time. Kind of the opposite of that is selling a call and buying a call at a higher strike price, and this is also called a bearish or credit call spread, where you're getting paid a little bit of money and you're hoping that the share price does not rise above your strike price over this time. If you're interested in seeing some examples of how I look at specific companies and decide on an investing strategy, check out the playlist linked in the top right corner. So to summarize this video, we've discussed the following. Investing is putting your money somewhere and expecting it to increase in value. Student loans are an example of how investments can be expected to increase in value. Bonds, stocks, mutual funds, and ETFs are different ways to invest. While mutual funds are probably the simplest way, ETFs probably strike a better balance between requiring little effort, incurring low fees, but still achieving good returns with lower volatility than individual stocks. Lastly, we discussed options as a way to adjust your risk profile when investing in stocks and ETFs to suit your personal risk profile. And that's that. If you enjoyed this video, please consider dropping a like, commenting, and subscribing to see future content. Let me know in the comments what you invest in or if you want to know something about options. Anyhow, thanks for watching and have a great day.